Hey, everybody. Welcome back to your Texas Market Snapshot, where I break down the latest in rates and real estate, help you stay ahead of the curve, I hope. But here's what's moving on in our world right now. A recent court ruling on tariffs rattled the bond market. Bonds dipped initially because if the U.S. has to repay all the collected tariff money, it'll be a significant amount of additional debt. It's not good for bonds. We'll see what the Supreme Court says, but the market quickly recovered this week. That's the good news. Now all eyes are on Friday's jobs reports tomorrow. Now, if it's soft and bond friendly, you could see another rally rolling right into the Fed's September 17th meeting, where there is an expected rate cut. But if the jobs report has a surprisingly strong number, that could send rates popping back up. We'll keep you posted on anything that happens, but stay tuned and pay attention if you're coming into contract the next couple of days. Now, let's set aside the noise on the real estate market right now, some of the negative stuff. Look, and I know there's some legitimate concerns there too, but let's put that aside for a second and look at the history of real estate. It's been one of the smartest wealth builders out there, right? In the last decade, home values are up around 90%. Now that is abnormally high, but let's say it takes 20 years to do that this next time. And you put 20% down, that's 90% gain. And that becomes a 400% return on your money because you used a smaller down payment to control a bigger asset. You're not just living, you got to pay to live anywhere. But you're also investing. Now, let's say you buy that house for $100,000, just for simple numbers. You put 20% down, that's $20,000 down. The bank loans you the other $80,000. Now, imagine the home's value goes up by 100% over 20 years. So it's worth $200,000. The house doubled, but look what happened to your money. You only invested $20,000 in the initial investment, but your equity is now $120,000. Your original $20,000 plus the $100,000 gain in appreciation. So while the house went up 100%, your money grew by 400%. That's the power of leverage, using a smaller down payment to control that bigger asset. And if you put just 10% down, that's 1,000% gain. It's like 50% a year annualized. Bottom line, owning a home isn't just about a place to live. It is a smart way to create long-term wealth in our current economic system. That changes, and we'll give you a new strategy. But I do want to give a big warning to sellers, and hopefully something to think about. This housing market isn't 2022 anymore. People are coming to realize that. But here's a standout point from Forbes. They recently reported that in June, new homes sold for about 9% less than existing homes. Hope you caught that. It means new builds sold for 9% less than pre-existing homes. That's the biggest inversion in decades. Builders are pricing to move. They're offering buy downs, closing cost help, or even, lower purchase price. Meanwhile, homeowners often hold firm on pricing. You're emotionally tied to your home. I get it. That's why this rule matters. If you bought before 2021, apply a 5% annual appreciation to your original purchase price every year that you've lived in it. That's fair, and that's what to expect historically on appreciation. Anything you sell above that's just bonus, okay? You make your return, and it's a good investment if you get that average of 5% per year. Remember the saying, pigs get fat, hogs get slaughtered. You're pricing your home like it's 2022, you're going to become the hog everyone hopes to avoid. You're going to extend those carrying costs, create extra stress on your family, and you're going to end up pricing it right eventually. Why not just do it now and use those buy down strategies to shore up the gap? Remember, your home is emotional. You got to disconnect that when selling. It's your house when you sell it. It's a business transaction. You're competing against builders who can shrink size, tweak quality, drop price to land a sale. Think about that. Price accordingly. For buyers, a potentially soft jobs report and tariff news healing could lead to better rate opportunities soon. Position yourself. For sellers, price right, use those smart incentives. Don't try to get greedy, get slaughtered, okay? And you may get passed over. That's your snapshot. Stay ready, stay informed. As always, be the Buffalo. I'm your friend in home finance, Andy Tuttle. Thanks for watching. I'll see you next time.